Good evening to everyone present here today. We have our CEO and co-founder Mr. Mohit Batra and our CIO Mr. Sunil Damania with us today, who will dissect this week's most significant happenings and their potential impact on the long-term market outlooks. Towards the end, we would also be having a Q&A session. You can drop any questions you might have in the chat box below. Over to you, Mohit sir.
Well, thanks a lot. Very good evening to all of you. Ending of a, I would say, good week for all of us. Specifically for MarketsMojo, I would say, because there was a lot of internal movement of stocks that moved up despite where the market was. So this has been a good week, and you would hopefully see many more good weeks like this before we start seeing good months and good years. This webinar is a power series, but let me just reiterate again, this is a future trend power series, which basically means that we would be unfolding what we've seen over the last 1 week. Are there any new future trends that are emerging? Every week we do this particular webinar. We started last week. This is the second series, and we intend to do this on every Friday in the evening at 7 or 7:30, today being at 7 o'clock. To make sure that we capture the whole week and try and figure out if there's anything that is changing the story moving forward. So future trends that happen that may alter our story, that may change our story, it's imperative that we bring that forward to you guys. So, this is kind of a culmination. If you see this one webinar, this is like a culmination of your whole 1 week of reading. Whatever we do, whatever we read, we will incorporate all of that in this particular webinar as an analysis of how we may see the future trend changing. So in the first part of the presentation, we'll have a presentation by Sunil on the future trend. Second part of the presentation, obviously, because it's a power series, we'll open it up for Q&A, which Sunil and me would address jointly. But before we start the presentation from Sunil, let me just make a very important announcement. Starting 1st of May, which is on Monday, MarketsMojo is going fully paid, which means that no unpaid user will be able to access MarketsMojo anymore. We are taking this very, very big step, primarily because we want the advantage of MarketsMojo to be rested only for its paid Mojo Professional members. And starting 1st of May, we would ensure that no outside traffic comes onto a paid section or a paid subscription product like Mojo Professional, and hence it becomes a premium property of only Mojo Professional users. Now, as you know that a couple of days back, we had started and given a benefit offer to all of you, which is 21,999 for 2 years with a 6 months extra. This particular offer is ending in few hours, and it is my responsibility that we tell you that we are ending this particular offer in few hours. So when we seek towards being more and more premium, the price of the product will keep increasing over a period of time. But this is something that we are putting our best foot forward, along with the announcement that on 1st of May, we will go fully paid. So let me just repeat, this offer is only valid for webinar users. This offer is only available for the next few hours now. 21,999 for 2 years, and we are giving 6 additional months free in this, which basically totals to a 41% discount, which is a huge discount, almost half the price which it would be on 1st of May on the site. With that note, you would have this link available to you after the webinar, during the webinar. Also, we will send it to you. Make sure that you have extended, make sure that you've taken the benefit of this 41% discount. With that note, let me hand over to Sunil so that he can quickly cover up the future trends, and then we'll open up the session for a detailed Q&A.
Thanks a lot, Mohit, and very warm welcome all of you. As Mohit rightly said, every Friday we try to see what are the trends that we can see, which could be macro, could be short term, could be long term, and try to understand what, if at all you have to do any action, you should do that. So what I'm going to do in my presentation today, I'm going to discuss about the mutual fund industry of India. What has been, I was discussing with one CEO of a company, and he was saying that, "Arey, bahut ho gaya abhi to." And I thought, bahut paisa aa gaya mutual fund ke paas. Is there a scope? And that really spurred a thought in my mind that where do we stand if I have to really compare India's number with the some of the China or Brazil or Japan or US, where do we stand in terms of their GDP versus mutual fund AUM, and is it enough? Number one. Number two, as we all know, that 2023 has been really challenging year, and if that was the case, how mature our retail investors have behaved in this time. So that's one data point I'm going to present in front of you. Another interesting thing, where I was talking to one of the fund managers, he said, Sunil, historically, when the IT does well, banking does not do well, and vice versa. And I thought, is that the trend? So I went back to the data analysis of year 2000 till 2023 just to understand, is that been the case? And if that is so, let me, why I'm talking about IT and banking, the reason why it came up, because the fund manager was saying that, is not the banking chalne wala, not the IT chalne wala hai. That was his analysis. And you'd be surprised to know that almost 51% of the Nifty 50 weightage is accounted by these two sectors, finance and the IT. And in terms of market cap, it's 60%, even though they account very small percent in terms of net profit. So what happens? Another interesting thing, which someone asked me, if I have to really do passive investment, where should I do it? And normally the normal answer would be Nifty 50. And then this thought spurred to me, if bank and IT software are going to be not going to do well, does it make sense for you to invest in Nifty 50? The solution could be the equal Nifty 50 index, which is there. And there is also ETF available. I'm going to present that data to you. Another slide that I'm going to discuss about India Inc. numbers. Then I'll move to very quickly about, we all know that on 3rd May, Fed is going to come out with the Fed policy action, and what could happen, what can happen there, and how do we see the future trajectory there on the rate hike or what the Fed would do next. And of course, some of the major events that took place in last 1 week, just to summarize, and then definitely we'll open the floor for question and answer. But before I begin my webinar, it's I must say that disclaimer, that this webinar is only for an education purpose. We do suggest you to please consult your financial advisor before you invest in the equity market. Remember, equity market does carry a little higher amount of risk versus return, and hence you to be very wary of the risk you take when you invest in the equity market, and past performance is no indicator of a future returns. With this, let me go back to the first slide about the trend that I see in about one is that about the mutual fund, and then about whether you should be, how do we see the IT and the bank, and within that, should you be going for Nifty 50 or Nifty equal weight index? So let me discuss with the mutual fund inflow. Now I must give credit to a lot of you people. Why? In my 30 years experience, I have seen a lot of maturity coming in from the retail investor. That's a one trend that is emerging very strongly. Not only that, I think more and more investors now started believing कि हाँ हमारे बस की काम नहीं है manage करना equity, and they are seeking more and more professional advice. Even it comes with the fees, like coming to MarketsMojo or going to the mutual fund, because they realize if they try to do on their own, they are not going to be successful, despite they may be chartered accountant, they may be financial literate and so on and so forth. When they have somehow, they do realize that that's a one big theme is emerging. So let me give you some idea. 2023 was extremely challenging year for the global fund manager. Forget about India, but global fund manager. And yet we saw inflow did come down, but it did grow. It did not move down. The reason why is that equity continued to remain still a darling of the industry, which used to command only 38% of money used to go to equity. Today it commands more than 50%, and I'll present that in my next slide. So if you look at equity exposure, and this equity exposure, I know you people will get confused with this. This equity exposure is across all the equity scheme. That's what is that's one. Then you have a hybrid scheme which also invests in equity and the debt. Then we have an index fund. Then we have a thematic fund like the sectoral fund and so on and so forth. We are at all-time high. In fact, in 2017, it was only 6.72 lakh crore. Today, we are looking at 23 lakh crore, almost 3.5 times in last 6 years. And what credit should go to you people? Because mutual fund doesn't generate its own money, am I right? It collects money from investor like you and me and then invest. It's at 23 lakh crore. That's, I think, is an all-time high. And what really look at it, this data is very, very fascinating to me. And there is a trend that you see. In 2017, if you look at it, only 38% was accounted by the equity. 38%, 62% was the debt market. And look at this, it now almost accounts for 60%. What is the reason why that? A lot of credit should go to the SIP. SIP is a one product, I think, that completely changed the color for the industry. And I think mutual funds here, and a lot of credit should go to the mutual fund industry. I think they've done brilliant marketing job in terms of making mutual funds here. And due to that, now it's almost 60. Of course, just came down from 61%, 58%. It's also due to the fact that market came down, and it's a mark to market does impact this. But the net inflow has been very, very strong, and how it has been strong is this. So I'll come to this slide a little later, but let's look at the discipline. I think discipline is the new buzzword, and I think that's what really makes me. If you look at the SIP inflow, market went nowhere in 2023, but if you look at the SIP inflow, it is constantly increasing. It was only 43,000 crore, which increased to 1.55 lakh crore. And even in the difficult year, which we moved from 1.25 to 1.55 lakh crore, I think, which itself is about 25% increase over FY 2022. And one of the reasons why you see equity flow positive, purely because of the SIP. A lot of credit should go to you people. Why? Because you people did not discontinue your SIP. In fact, there is one more trend which I have not covered in my presentation, is that more and more fund investors are going toward the ETF. Some unknown reason, I know why. One of the reason could be that they are underperforming, active funds are underperforming, and that could be the reason why they are maybe moving towards the ETF funds. But I think SIP flow continues to remain very, very strong. And if we look at the AUM only through the SIP in the mutual fund industry, it also grew by almost 1 lakh crore, almost about this. 6.8 lakh crore is a fund that industry is managing. So you know it's a 20 lakh crore out of which 6.8 lakh crore is now accounted, almost 30% is accounted by the SIP. And even if you look at the number of SIP which is there, it's increased to now 6.36 crore as compared to 5.8 crore. What does this two indicates? Not only the number of SIP increased, but amount of within the SIP also increased. And due to that, if you look at the number of active investors in the mutual fund has also increased very significantly. Now coming to the basic point of, is there a further growth? That one I was talking to one of the CEO and he was telling me that, boss Sunil, bahut ho gaya. But look at it. We are still scrapping the surface. In fact, if you look at it, India accounts, in India, the AUM to GDP, this ratio is AUM to GDP, is only 16% as compared to someone like US is 140. Of course, US is someone would always, I would say, not a right data to look at. But look at someone like Brazil that we can compare with because a part of BRICS, 77%. Even if you look at China, it's 18%. And China, the mutual fund has been relatively new as compared to India. India, the first mutual fund started in 1964. There's a huge runway that's available for the mutual fund industry. Our sense is that retail investors become more mature. That's a trend emerging. They have not stopped their SIP. That's a very happy sign. Despite they did not see any returns coming in. In fact, the SPIVA, which came out with the report very recently, which says that almost more than 90% of the large cap funds underperform over a period of 10 years versus the benchmark. So I think, and yet we do see retail investors showing. So the major takeaway, number one, that mutual fund industry is likely to grow very handsomely if you go by the AUM to GDP ratio of the other countries, other parts of the world. And India, in fact, in India, somehow the financial tendency to go for financial is now increasing. Financial saving is increasing. Previously, investors used to go more towards gold and the real estate. And today, I think the trend seems to be reversing. More and more people are not willing to go for the, especially the real estate. I think that's where somewhere people are not very comfortable now. They try to basically put largest sum of your money to the real estate. So I think once the financial savings, the ratio of financial saving goes up within the total saving, I think mutual fund would be one of the biggest beneficiary. And I wouldn't be surprised in next 5 years down the line, the AUM to GDP ratio is in excess of 30% or so in India. So that's the one trend that is emerging, the discipline and the SIP flow. Now, it comes the finance and IT dominates. And and the reason I'm discussing this trend now, again, based on one of the fund manager, where he said that dono saath mein kabhi nahi chalte hain. Now that's a thing, that's a danger, am I right? Now, if you look at the net profit wise, in terms of top line, banks, finance and IT software accounts for 27% of total top line of India Inc. When it comes to the net profit, they are just at 3.5%. Just 3.5%. But they account for 61% of the total market cap. Isn't it very surprising?
Absolutely.
Okay, and I think that's where. So now the question comes, अगर IT नहीं चलेगा, software नहीं, अरे banks नहीं चलेगा, finance नहीं चलेगा, तो market कैसे चलेगा? I think that's the biggest question that would come in everyone's mind. So what I did actually, I looked at how does this both indices move, and what I did is that I've looked at the Nifty bank performance and Nifty IT performance since year 2000 till 2023. Remember, right now as we speak, YTD, both banks and software are in red. Something similar happened in 2011, if you look at this way, where both were in negative. Only 5 times both were negative. But it's a general perception is that both don't move in tandem, am I right? But if you look at it, both positive has happened in 11 times. In other words, 16 times they both move in the same direction. If IT software was down, Nifty bank was down. If it moved up, it moved up. So there is a strong correlation. They both move. In fact, that fund manager was telling me that dono chalte nahi hai, reverse chalte. That's a wrong assumption, I would like to say. Number one. Number two, bank Nifty normally tends to be more positive in last 20 to 23 years as compared to IT software. Why? 16 times bank Nifty has given positive returns as compared to IT software, which is only 12 times. So there is a gap. But right now, it looks like right now that there could be a repeat of 2011. What was the 2011 where both Nifty and, of course, I don't expect market to be negative. Let me tell you very frankly. So I must clarify that. It does give an indication that we might see. There's all probability. Please remember, we are all talking about the probability that may or may not happen. Okay, my prediction can go wrong, but right now, both are in negative. There is a probability that they both could be negative in 2023. It happened in 2011. It happened in 2008. That was exceptional year. So, but in 2000 and 2001, 2 years in a row, both gave. And of course, that was again exceptionally high. It was Y2K boom and bust. In 2001, we saw 9/11 scenario, spooking the market sentiment very badly. So how do we play then? If this is the trend that's good, looks like emerging, then how do you play that actually? This is the Nifty 50 weightage of financial service and IT. If you look at it, almost 52% is accounted as of March 2022. 52% is accounted by financial service and IT. So अगर market में बोल रहा हूँ चलने वाला है, overall there will be positive, then why there? How do we play this? And if we were to really take a passive ETF strategy, which a lot of investors are moving towards, how do we basically play out? So I thought let me do one interesting study about the Nifty 50 and Nifty 50 equal index. Okay, and what has come as a very surprise to me is that it makes a lot of sense to invest in Nifty 50 equal weightage index as compared to Nifty 50. So if you are now decided to go for ETF and so on and so forth, instead of go for Nifty 50, go for Nifty 50 ETF. I do get a sense that Nifty 50 equal weightage index should outperform as compared to the Nifty 50. And even if you look at the historically, in last 24 years, 14 years, Nifty 50 equal outperformed the Nifty 50 index. And if you have to look at the CAGR returns, Nifty 50 equal gave 12.7% return. CAGR since year 2000 till today is against 11.1% by Nifty 50. So if in your piece of investment, if you do have a active and passive, I think this trend will give you some idea about where you should be now parking your additional fund, if at all you wish to park your funds in the Nifty 50 or Nifty 50. And there do ETF is too available. I just checked with Karan, my colleague, and he did say that yes, it's available by some of the AMC in case if you wish to really explore. And this green does not mean that return is green. It does indicate which outperform versus the other index. Okay, so let me clarify that also. Now March quarterly numbers, again nothing great to talk about. Let me tell you very frankly, last Friday the top line quarter on quarter was negative. It has turned little positive. My sense is it will turn positive as your number. Almost 1/3 in terms of market cap. I already declared the numbers, but I think net profit is really muted. And I think we need to, and as I told you, market, the corporates, the more you listen to the corporates, I think the one common theme that is emerging from the Q4 number is that, number one, that everyone is waiting for what happens to the monsoon and impact it can have. And number two, what happens to the global economy. I think there is some amount of uncertainty that is happening. That yesterday the US came out with the first quarter numbers and growth was only 1.1% annualized. Okay, so it was much below that what the belief was or the general expectation was. So I think corporates are a little skeptical. They do understand that the pent-up demand which was there post-COVID is no longer there, and hence they are looking at their growth book in a more measurable manner, more in a muted manner than anything else. So we will need to wait and watch. But right now, number doesn't look very, very exciting as we speak. What is a trend that has emerged in the month of April? Today was the last day as far as India is concerned, and US market is just open, so we'll come to know. But Indian market outperformed the US market, and Mohit in the beginning of his webinar he mentioned about week was good, but Mohit, this month was good.
Yeah.
Because the small cap index was up by 7.3%, mid cap index was up by 5.9%, and Nifty 50 and Sensex, they were up by 3.2 and 3.6%. And first 3 months, US market outperformed Indian market. For a change, in April, Indian market outperformed the US market. And if you look at Nasdaq was down by 0.7% or so. In fact, Nasdaq has been one of the best performing index of YTD in the US as compared to S&P or Dow Jones. But it did see some amount of profit booking happening, and that's a normal thing. Sometimes, something which moves up very significantly, do see some amount of profit booking. That's what exactly happened in one of our Mojo Infinity stocks that we discussed in the previous webinar, and that's a normal. That doesn't mean that you need to get little panicking or so. So I think April turned out to be a very, very good month for the Indian equity investors. Fed rate hike, that's on 3rd May. The base assumption is that it would be 25 bips rate hike. No surprise there. I think almost everyone believe that unless something happens in the next couple of days in the US, that could, because that's something similar happened last time where SVB episode come up and for Fed was forced to hike only 25 bips as compared to 50 bips. So right now 25 bips rate hike. But I think the basic assumption that the complete market, the whole world is basically backing in right now, and the assumption is that this would be the last rate hike from the Fed. And it's very, very interesting to listen to the commentary and the body language of Jerome Powell when he make this meet the what we call reporter there in the US to understand what is his body language says. We do believe after 25 bps rate hike on 3rd May, some kind of a stop would be there in terms of rate hike. And then our base assumption is that we should expect rate cut in 2023 from the Fed, purely because of, I think, US economy would warrant a rate cut. And that's what, of course, Jerome Powell has ruled out in his last Fed meeting, but we do make that assumption. We will keep visiting this when we come back to you next Friday. We will cover Fed policy action and what do we expect going forward. We will cover that. But right now, 25 bips rate hike, no more rate hike going forward, and and the rate cut, at least one rate cut in 2023. These are the major news. I think FI were net sellers this week. Price of oil did go down below 80. That's a very happy news. If you remember, the OPEC did announce a rate cut, a production cut, and did see a spur in the crude oil prices. But then some weak economic outlook did bring down the price of the crude. Sugar seems to be one gray area, I must tell you that. El Nino, and in fact this year the sugar production would be less, even ethanol production would be less. But despite that, India is expect to meet sugar domestic demand and also export to some quantity. But don't expect too much export quantity being exported outside India. In fact, the price of the sugar has moved up internationally also. And I think that benefit should flow into the balance sheet of profit and loss account of the sugar companies, provided they are able to get enough sugar cane to process that. So we need to wait and watch. But right now, and depending upon which part of the state there is a deficit monsoon, that could impact the sugar production and so on and so forth. The commentary from the IT sector has been a little mixed, and company like Wipro guided -3 to -1% kind of a top line growth for the June quarter. Some of the mid-cap companies came out a very good set of numbers, and LTT's one, for example, came out a very good set of projection for the next year. So our sense is that IT is becoming more and more stock specific than the broader story. There will be some companies, that's the trend that is emerging based on the data coming in, that some companies will do well, some companies will not do well within the IT space. And hence, rather than having a view on the IT as on a painting with the same brush, I think you need to now become more and more stock specific. We have seen some companies within the IT software doing extremely well, despite there was a little gloom and doom kind of a scenario in last 15 days or so. While industry and ICICI both reported deposit advance growth, I think there is one concern that seems to be coming out very clearly, is that NIM seems to have reached a peak, and hence I think NIM could see some pressure coming in as early as June quarter, and maybe NPA could become a issue to discuss somewhere by the September quarter. That's the trend coming in. If you look at the mall operator, why we are taking this data, just to understand what kind of consumption growth that we can see in this financial year. And I think the mall operator is talking about 7 to 9% revenue growth in FY 2024, which is, I must tell you, is below the nominal GDP growth. Why? Because the nominal GDP growth in the this year FY 2024 has been pegged at 10.5%. So that's what the 7 to 9%, that's what it says. So consumption right now seems to be a little concern, looks like. That's what I'm getting a sense at this point of time. And US economy has just grew by 1% as we speak, 1.1% for the first quarter, clearly showing there has been a little slowdown in this one. Just to repeat before I hand over mic to the Mehta, is that we do have a very good offer, as Mohit rightly said. For last few hours it's available, 21,999 for 30 months, which works out to near about 25 rupees per day, which is a peanuts that you need to pay to avail all the powerful features of MarketsMojo. Remember, this offer is only available those who are attending this webinar. Otherwise, on our website, this offer is not there. You don't get 6 months extra, you get only 3 months extra. I'll again request all of you, those who are a little serious about creating wealth, should explore MarketsMojo subscription. Again, disclaimer, this webinar is only for an education purpose. Whenever you invest in the equity market, it does carry a little higher amount of risk, and past performance is no indicator for future. Over to you, Mehta.
The first question for today is from Mr. Ajay. Hi Mohit, I remember you saying that you wanted to start a mutual fund in future, But isn't this opposite to equity by direct investment in stocks? Is your goal for return from equity softening?
No, I don't think so. The return from active funds is softening. When you talk about mutual funds, there are various strategies that you need to adopt. When you talk about mutual funds, it also talks about what kind of fund structures you can have, what kind of fund strategies do you have. And I personally believe that we have something differentiated that we are planning, which may be differentiated strategies from the existing mutual funds that are currently available in the market. More and more, the requirement out here is that if you cannot beat the index in the longer run, you, in a way, don't deserve to be in business. I mean, this is a straightforward talk that I'm doing out here, which is if you're not able to beat the index, on a longer term basis, you may grow your AUMs today, but you will not be in business moving forward. So when we are looking at mutual funds as a possible business to add on to MarketsMojo, our objective would be to beat the benchmark. Now, beating the benchmark has various ways in terms of active funds as well as in terms of combination and allocated passive funds, which is something that the industry has just about started talking, and that is something that we've been talking for a while now. In fact, we may decide to launch active index allocator in our PMS strategy as well. So that is something that we are continuously looking at. What is the kind of funds and what is the underlying strength in the market that we can use? One strength, obviously, the deepening of the fact that the market slowly will keep getting penetrated. And if you look at specifically the large, mid and small cap kind of a growth out there, the fund size matters a lot. You may start small where you have the size to allocate into small caps, but as the fund size becomes bigger, you keep allocating over larger mid caps like mid caps and the large caps. So there are various amount of factors. You can limit your fund size collection. You can also look at various strategies on the index side. We also have a global IP, and one can look at global fund strategies. Why to just invest in in one market? Why can't we create various ETFs across various markets wherever the growth is? So whenever we launch or plan to launch mutual fund, our fund strategies will be very different. And predominantly, the whole sense should come to you that it is actually a hardening of the equity approach, not softening, because we are not a debt player. So we do not want to get into a mutual fund business with debt as one of the offerings. We would be playing equity as we are playing in PMS, as we are playing in MarketsMojo. So the line of thought is equity. The line of thought is outperformance. The line of thought is to make sure that either you create it through active fund management, and the line of thought is how can you create it through even passive funds locally as well as globally. I have never kind of summed up my whole strategy so eloquently internally as well. But thanks for the question.
The next question is from Mr. Sonu. You make a disclaimer to consult your financial advisor, but what to do if MarketsMojo is the sole advisor that I use?
So your consultation is the whole Mojo professional pack, because that's where our whole approach and our whole sticking out the neck goes. This is the disclaimer is to make sure that whoever is your financial advisor, it can be MarketsMojo, it can be somebody else, you need to consult before you invest. We may put our best effort, but we are a drop in the ocean as one of the financial advisors. You may take a decision by talking to somebody else. You may take a decision to also take your own calls, talking to your friends and family and all of that. So what we advise is that instead of the disorganized way of taking advice and implementing that advice, go to a stable financial advisor. It can be MarketsMojo, it can be anybody else of your choice, because many people do have multiple advisors as well. But do not take a call purely on your own inkling and on your own information and research. Please make sure that it is authenticated, it is deeply researched. It doesn't mean that sometimes the advisor cannot go wrong. There is always a chance that the advisor can go wrong, but at least in the longer run, you would have not an educated guess, but you would have something which is a displayed fundamental parameter on which you took a call, which can also go right or wrong. But having a financial advisor on your side, it will always help. please understand this is a business that everybody thinks they understand, and trust me, nobody understands, including us. It is a best effort business. Even for the advisors and the experts, it has always been a best effort business. A best effort comes from people like us advisors more because this is our day and night job. A best effort may not come from your side because you may be doing various other things. But the base reality and the funny thing out here is that everybody believes they can invest. Everybody believes that they can be good investors and they can make money in equity markets with or without advice. Our only approach is that yes, you can, but make sure that your chances of being successful in equity markets can proportionately increase if you have a decent advisor on your side.
The next question is from Mr. Vineet. Sunil ji, how do you read the prospect for IT in remaining 2023? Results have been mixed. Should we look at moving our allocations to industrial and banking sectors?
So, hi Vinit, I think I did cover about banks briefly. So, I think you need to look at IT software purely from company to company now. I don't think we are going to see a broader rally within the IT sector, at least not for next 1 or 2 quarters. Why? Because of little uncertainty of what's happening in the US and within the US, what's going to happen to the BFSI space. If you remember, in the last Friday, we did talk about the commercial real estate, and that concern continues to remain there. It's not gone away yet, and hence that's one area that we need to be very, very careful. There's some of the company which has come out with a very good set of numbers, and their focus is not more on the BFSI, but they are focused on some other engineering and other stuff. I think the commentary seems to be more robust as compared to some other other players. So focus companies go specific, company specific, and that's where your alpha can come from the IT sector. We do believe banking could see a pressure, as I was mentioning about, and in fact, not me basically, ICICI Bank did mention in their con call post result that NIM seems to have picked, and now it can come under pressure going forward. While NIM could come under pressure by June quarter itself, I think whatever the growth that we have seen in the complete banking space has happened all through the unsecured loans. And if you look at today's SBI credit card number, I think they also came out with a very good number, which is again credit card is an unsecured loan, am I right? So there where the probability of entry could going up is very, very high. And in fact, RBI yesterday only made a statement that we are closely monitoring the business of the banks and the NBFCs to understand is there a systemic risk to the economy and to the banks. So I think right now the thing doesn't look very rosy for the banking. Of course, we are all a slave to the input data coming in. In case if for some reason the data which comes in is contrary to our right now assumption, we will change. But right now it doesn't look like that banking will. Industrial, I think, is a one sector that should looks little more promising purely because of the government focus on the infra, on the capital goods, and that could come as a big positive. And if you remember also, this sector has not done well since 2008. In fact, it was the darling of the investors from 2003 to 2007 and post-Lehman crisis. I think this sector did come under some amount of a pressure. It has underperformed very significantly. Maybe the law of average should kick in there also and should do that. So my sense is, just to summarize, IT software, be company specific, point number one. Industrial, yes, it does look little promising. And banking overall looks to be little challenging as we speak.
So, Vineet, I maybe add a little points to what Sunil is saying. If I was to close my eyes and look at one sector that I would invest in the next 10, 15, 20 years, what does that sector globally come into your mind? And I think the clear answer to that is IT. There is no taking back that the way the world is moving, the way the technological innovation is moving, the way the technological intervention is moving across all businesses across, right? If I were to look at and given a choice that, out of say 30, 40 odd sectors, which sector will do well in the next 10, 15, 20 years across the globe, I will only choose IT. Now, if you look at the various factors that are going around today, and I think, I'm not going to be talking about banking because that's a big risk factor that Sunil is already talking about. But in terms of look at the IT companies, they are extremely agile. Have you come out and seen, apart from the private banks out there in the US, have you come out and seen a big retrenchment happening in banks? The whole objective, the whole DNA of an IT company is it's a new industry. It's a new established industry, right? So when I say new, it is very young. So when I say young, their ability to move on the cost is very fast. You would have seen from Apple to Google to Facebook to various Indian companies, everybody going on a retrenchment mode. So they are young. They are they can move fast. They understand the definition of moving fast, and predominantly the use case is not limited to one line of business, right? Although Indian, I think the revenue share of the Indian IT companies onto the US BFSI segment, as Sunil was telling me the other day, is close to around 30-31%, right? They're on the export side.
35%, yeah.
Right. So, but still, there is the use case of going into other sectors. There is a use case of IT being touching on every single sector that is available in the market. So, today, we may say IT as a prospect on a short-term basis doesn't look that good because primarily of interest rate and the cost adjustment that various companies have to do. But in terms of the positives that are happening is active cost rationalization. That is something that you're reading about and that you're seeing out there. Active penetration into other segments that is happening. That is a very, very big point. And to me, the third and the most important point is that you cannot escape that. Today, in our portfolios, some of the top performing companies are IT. If I had stayed away from IT as a segment itself in our portfolio strategies, today I can tell you that one of the fastest growing performing company in our portfolios is an IT company. In fact, 2-3 of them I can name, right? So it is always to make sure that the sector trend should not confuse you with the active stock picking, because that is something that will make a huge difference. Why? The reason is, as soon as the sector revolves, which that we've seen in the last 6 months only IT sector revolve, right? So in the next 6 months also you can see it revolve. You want to be in the right powerful business. Forget the stock. Are you in the right business? Are you with the right company? Because it will sooner or later evolve, because broadly speaking, the way IT is going, it is going to capture a lot of wealth across the world, a lot of relationships across different segments. So I think, we must observe IT very closely, and I personally feel that the problems can be short-lived. And I think the turnaround also can be pretty fast. And, I don't know what Sunil's view is. These are my personal views. I can be wrong out here. I will not read the disclaimer once again. That has already been read twice by Sunil. But my personal view is that IT can surprise every single fund manager and every single investor, maybe within this year, very soon.
The next question is from Mr. Rupesh. I have succession and question: if any stock have not given a positive return after holding a stock in portfolio for up to 180 days in a client's portfolio, is it good to move in any other good price movement stock like Saxoft Computer or for better return?
Wait, would you like to?
See, there is no thumb rule if the stock price is not moved for 180 days. Also, obviously, it worries you. Typically, it also depends on what kind of a market scenario you are in, right? Let's assume that the market is 10% down and your stock has not moved anywhere. Has it done well? The answer is it's done very well. But if the market is in a scenario where the overall market and is going up and then the stock is not moving up, it's a bad scenario. So it is a very there is no number of days that you can evaluate. I think the only thing that you can, Rupesh, out there see is whether because if you're talking about 180 days, I'm assuming that the results are out, what is happening with the company, whether the quality of the company is still great, whether the current financial trend, the results trend is looking great. And sooner or later, what happens is that sometimes a company takes a little more time to get rewarded, and sometimes the company doesn't get rewarded the way we expect it to. So 6 months is not a hard line. Why not 3 months? Why not 9 months out there? So I would say that the only thing that you need to look at is that what is the opportunity cost of holding this stock? Can you move into a better stock, right? That is, I think, also what you are asking, Rupesh. And the answer is obviously yes. If for 6 months, 8 months, 9 months a stock is not moving well, you are purely also losing the opportunity cost. But do not, there are some stocks that do take time to move, and most of the time there is this whole catch-22 situation happens. And you know, as retail investors, we've always seen that जैसे ही मैंने हाथ लगाया stock नीचे गया, जैसे ही मैंने छोड़ा stock भाग गया. So all of those kind of symptoms come in play. Provided you have ability to have a neck ache where you can't look back. You need to have stiff neck in equity markets that you don't look back, right? If you look back, then all your decisions are flawed decisions. And if you keep looking forward and keep learning from it, then I think I would typically, if a stock is not moving for 6 months, I would move into, into a better stock. As I said, depending on where the market scenario has been. And whether you move into Saxoft or you move into any other stock is very dependent on, you know, what kind of a profile you come from. So that answer I would not be able to firmly give you on this.
See, I think one classical case, if I have to drive home the point which Mohit said, there is nothing called hard fix. When if you remember, ITC was one stock which moved in a very narrow range, and you know, some of our investors did write back to us, "Arey, stock tabhi bahut thak gaya hai. Why don't you move out of that?" You know, that happened somewhere from August to Jan or so, where it moved in a very, very narrow range. In fact, it did move down from that level also, August level, say. But today it's at 52-week high. So I think your reason script has not moved up, and hence to make an assumption, you know, that is called recency bias. It's a behavioral finance issue where, you know, something you believe has not worked in 6 months is not going to work going forward also, which is a very wrong way to look at it. So my answer is that don't put this kind of a thumb rule when you invest. Probability is very high, probability that you would go wrong. You will go right in couple of times, but most of the time you will go wrong.
The next question is from Mr. Gala. Hello Mohit and Sunil ji. Greetings. A welcome move from May 1st. More funds are going to mutual funds and ETFs. Is it a good sign for advisory like MarketsMojo? Stocks do rise and fall based on whether mutual funds build or dilute their positions. I remember Mohit saying an ETF dominated market is not a great sign, if I understood it right. Can we still generate alpha going forward with such trends? Please enlighten.
Mr. Gala, very good evening to you as well. I did not say that ETF driven market is not a good market. In fact, every market, when it matures, it will move towards ETF. The smaller players who are managing smaller amount of money will still be able to actively perform. But when the market matures, if you look at even US today, 60% of the money is lying in passive funds. The reason is the size of the market is so much that it becomes, mutual fund charges around 2% or 2.5%. If you are considering that into your returns as a cost, and then you're trying to beat the index in a overpopulated equity market where the markets have been very nicely penetrated, then beating the index becomes a hurricane of a task, a huge task. So there are two ways in which you can play this. One is typically that you have a boutique size and you typically do, as they say, close-ended funds, that you will say, okay, I will have a 5,000 crore fund and I will make sure that I deliver returns on 3, 4, 5 years, and I will move on to collecting the next 5,000 crores because I'm not taking that kind of an exposure in the market. The second is how well you can innovate in the market, because broadly speaking, typically if you look at the whole share of large cap and mid cap, and I think Sunil may correct me here, but today the market cap share of the larger companies is over 90%, right?
Large
cap would be around
maybe 80%.
80%.
Yes.
Yeah. So large cap is 80% in terms of market caps, and maybe another mid cap will be another 15-17%, and the remaining is small cap. Now, if you have this kind of a construct, how the hell are you going to beat the market? Right? If you are a very large player, because your liquidity will be only absorbed in the large caps, right? And it becomes very difficult to then actively beat the market, and that's when various other strategies come into play. that's when either you're boutique and you're managing less money and you're, you typically go on that path, or you come out with something which helps you catch the right sector and then you move into that sector, right? We will typically give you an example. I don't have the names, but I was seeing over the last 1 year, the top performing sector and the worst performing sector has a divergence of 40%. Right, so basically the top performing sector, if it has given you, for example, a 20%, I don't have hard numbers with me, but if it has given you a 20% positive return, the worst performing sector has given you minus 20%. So if you were to even play the sectors nicely on ETFs, it can be a great alpha opportunity, because you could have earned 40% if you were avoiding certain sector, if you were in the right sector, if you were in the right market cap, if you were in the right asset class. You could have been invested in gold, you could have been invested in debt when you feel that the markets were being bearish. You could have moved into G-Secs, for that example. You could have moved into any of the sectoral funds and the broader indices as well. So I think a lot of innovation is required in terms of active management of not just the stocks, but also asset classes, also market caps, also sector allocations. And unless you do that, more and more it will keep becoming difficult. So if you see the history of any large cap fund or any fund house that starts small and becomes larger, the fund manager's job is predominantly to remain at the index or maybe beat the index by 1%, because that is the human capability of doing that. It cannot be more than that. So it's a very complex equation to manage. But having said that, the need of active managers, will it be there? The answer is there, because why is that? Why is the answer there? So if you look at the index, if you look at just investing in the index, you would have got a 11-12% return over the last 10 years, right? If you were to go with any of the large cap, mid cap fund, you would have maybe earned a 1% more or 2% less, or maybe 1 or 2%. लेकिन उसमें मजा नहीं आता है. If today somebody says, where have you invested? And I say that I have invested in the, Nifty 50, versus if I say I have got this Sundaram blue chip, this fund, right? Which is more glamorous. So that is one thing which will always happen. The other thing is that you need strategies which are smaller. You need strategies which are more focused. You need strategies which have proven track record to give you that kind of a return, not just any fund strategy that you can invest out there. So it's maybe, with our future steps that we'll take on launches of new structures, you will understand what I'm talking about. But I think it's a very, very complex one. And will there be need of active managers? Always there would be need. Would the passive industry increase and grow? The answer is yes.
So I think it's a function of, are you happy with the market returns, or you want more than the market returns? If you want more than market returns, you will have a active strategy, and if you are happy with what market returns are, you will go with the passive funds. Like Mohit was talking about the best, the worst, and while Mohit was talking about it, I was looking at large and mid cap. In last 1 year, the best performer is 13.34% up, and the worst is down by 13.27. So one gave positive returns in 1 year period, another one gave negative returns of 13%, and that's what the divergence that's happening within the active space.
The next question is from Mr. Govind Sami. Dear Dr. Mohit and Mr. Sunil, can you confirm my question on PMS's way forward and fee structure?
Sir, PMS's way forward.
Inflation, but I think just before, while Mohit was, that's what our sense is. I think Fed did to realize, and they've realized, that's one of the reasons they did not go ahead with the 50 bips rate hike. They just went ahead with the 25 bips rate hike, am I right, last time? So our sense is 25 bips rate hike, that would be the last rate hike, and number one. And number two, maybe by end of 2023, because economy doing not so great, we should expect rate cut. That's what our base assumption as we speak.
The next question is from Mr. Praful. Hello Mohit, greetings. BSE 500 rose by 10.54% and the index is now positive for 3 months, 6 months and year end. The advanced decline ratio is also better. Unfortunately, our portfolios have not seen such returns, let alone alpha. has always maintained that when the index rises, Infinity portfolio rises faster, which I am not seeing. Does my portfolio need any intervention? Can you
No,
please
sir.
share some thoughts?
No, sir, it doesn't require. There are some stocks that take a little time. We are evaluating those stocks on a day-to-day basis, I can assure you. See, the other thing that happens is that there is a lag performance that always comes in. So, on a 1 month basis, I am not terribly happy, not sad about index moving anywhere, because it doesn't show the broader trend that needs to percolate down to the portfolio level. We've seen a lot of healthy improvement. See, please understand that MarketsMojo's strategies are a little high on beta, which means that they have a risk of going a little down when the markets are down, but they also come with a very high level of probability of alphas when the markets start moving. Now, the gearing up of that takes some time. I don't think so there is anything to worry about, and I can say this with huge amount of comfort. The reason I'm saying that is that our total number of model portfolios, our total number of infinity portfolios, we are tracking that on a day-to-day basis in terms of how their movements are, how many clients are now in the positive, how many clients are beating the index, and that number has shown a complete V-turn. So slowly, obviously, now there is, if I was an X percentage and the Y percentage has been achieved, a Z percentage will be achieved next month. But now the trend has started going up. So just be a little more patient, and I think things would start looking up.
So that's it with the Q&A session, sir.
Well, thanks a lot. This is a long weekend. Saturday, Sunday, and Monday. I think markets did well also because a lot of us got long weekends after weekends this particular month. This may be one of the last ones out there. But enjoy your weekend, and we'll see you soon. Thank you so much.
I think tomorrow Jason is there. Am
Yeah.
I right? So I think we'll have a webinar tomorrow also. So please do attend that. Thanks a lot, everyone, and just don't forget that last few hours for the subscription. Over to you, Mehta.
Thanks a lot everyone for attending today's event. In tomorrow's webinar, we have our product manager Jason D'Souza, who will share with us strategies to apply while investing in Mojo stocks. Hoping to see you all tomorrow. Goodbye and have a great weekend.